Yeah, actually, I think the Bank of England also has a lot of work to do. I think, unfortunately for the Bank of England, they also are a little bit behind the curve in terms of their forecasts. They've been forecasting a recession for quite some time, and I think it just hasn't appeared so far. And inflation also is far above their Bank of England forecast. So, tomorrow we're going to get their monetary policy report, and I think they're going to need to upgrade those forecasts. And at the same time, we'll see exactly what comes out from their inflation projection, their interest rate projections, because that is really going to be, how they can manage that message with upgrading the inflation and growth forecast, but still trying to be dovish.
Yeah, one thing. So you raised a couple of points. The first is on the growth side of things. It is interesting that back in February, they were forecasting calendar growth for this year of minus 0.5 percentage points. I think the view is that going into tomorrow, they will revise that upwards and basically, with some degree of confidence, say that we are no longer in recession territory. So that's, major headline for markets and broader people who are watching the Bank of England. But on the inflation forecast, with the exception of this year, if you look at 2024 or 2025, their inflation forecast is still sitting around 1.5 percentage points and even half a percentage point 2 years out. So you could argue traditional monetary policy would dictate that, if anything, they are too restrictive right now because they're going to be below target in a couple of years.
That's definitely the case if their forecasts hold true. But unfortunately, we've seen that they've needed to revise their forecast so significantly that it's very difficult for the market to really believe that inflation is going to come from 10% right now to 1.5% next year. And so I think what we'll end up seeing is that they need to increase their forecast for inflation next year, which would then also push their inflation and their interest rates to be into less restrictive territory. And again, you just kind of look at it and say, if they were this far out already, how much more does the market really trust them? And how much can they still deliver that dovish message without appearing that they're actually ignoring the data and not being data dependent?
It's just interesting when you look at interest rate pricing that investors are quick to go from end of the hiking cycle to rate cuts. But what if we just end up in a situation where rates stay very high for a longer period of time? Why is that not being priced in as a baseline outlook?
I think there is some risk of that, and I think the market does understand that can be the outcome. But I think it kind of goes back to that risk of something breaking. And so when something breaks, then you need to have that kind of downward trajectory in interest rates. And I think the other part that we'll need to look at is kind of saying, once interest rates are restrictive enough, as inflation starts coming down, the Fed, the Bank of England, and the ECB should start cutting rates at a more gradual pace to kind of keep up with that, right? Because as inflation falls, then they do need to also bring their interest rates lower. And so I think that is also what we can see starting next year, to see a little bit more, if inflation does kind of drop off, if you do kind of remove some of that stickiness, then you could see those smaller cuts from the central banks.